were some. Supervision failures, which clearly there were some, or failure of regulation to just miss it. And so, whether or not we've got to look at law is not really decided that.
Why is it not good policy to tell the American public that all their deposits are safe with every bank across the country?
It's not about the depositors, it's actually about the leaders of these financial institutions. It means that the moral hazard risk here is that you have basically government insured money sitting in your institution, and you can take whatever risk you want with it. And if you do very well, great, you get to keep the benefit. And if you fail, you socialize the risk. That was the knock-on effect, the moral hazard from the financial crisis, where executives did lose their jobs and failed in institutions, and they should have. What is clear with these two bank failures is the executives in charge lost their jobs. With any bank failure under operation of law, they're out. What we don't want is to add more risk to the financial system in the name of a short-term problem. Now, stepping back, how can you deal with this? Well, the Fed is the lender of last resort for banks. That's a 100-year-old proposition. It's actually much older than that, the theory of a central bank. So what the Fed did in stepping in here to lend against good assets and provide cash for good assets is typical of central banking through the ages. They did what they're supposed to do. My question is, why did they do it after the fact and not leading into the crisis to avoid the crisis? And then the question for the FDIC is really the thinking on why it took 3 weeks to sell this institution for a massive loss, and why couldn't they have had a better deal that first weekend and have more stability coming out of that weekend. So these are things that are really typical of bank failures. Final thing that I'll say on banks. For capitalism to flourish, failure must be permitted. Without failure, you cannot really have the true benefits of capitalism. And if we have a financial system and a banking system so fragile that a bank can't fail without pulling down the whole economy, then we've done something wrong. It has nothing to do with the reason why this bank failed. Liquidity provisions of this institution, they would have passed flying colors the original Dodd-Frank Act. The question of a living will is about how you break up the bank after the fact. Didn't have a damn bit to do with this institution. That is politics, not policy. That is politics, not actual serious legislating. That bill in a previous Congress, in a previous generation, would have been called a technical corrections bill. And because Congress was so broken, it's heralded as masterful legislating. This was low stakes, small changes to Dodd-Frank that we should have done a year or two after Dodd-Frank. This was not revolutionary stuff. One of the questions that the chair of the FDIC needs to answer is whether or not an ideological lens prevented him from selling Silicon Valley Bank or Signature Bank that first weekend.
Explain what you mean by that, though. You said that to me, and I don't quite get it. So why don't you put a little bit more meat on it on there?
I'm just great setup for a question. That's a tricky setup for a question. I appreciate it. So this administration has had a very harsh view on bank mergers. They have a very novel view on competition policy. That lens has been brought into the financial regulatory sphere in a way that is not consistent with safety and soundness of these financial institutions. So if it was ideology to say, I don't like this firm, I don't like what this firm does, and they said, we're not going to sell it to you, that actually had a severe impact for America for the last 3 weeks because they didn't hitch it up to somebody that they didn't prefer.
Meaning a big bank or something like that.
Yeah, or private capital that could have taken these assets and made them safe and sound, depositors hold, without it hitting the deposit insurance fund. There are far cheaper ways to go about this, but that means you have to have all players at the table willing to compete for the these assets. And that appears to not be the case in that first